The report we analyze today draws on views from Goldman Sachs's latest research note. In this issue of Industry Pulse, Goldman Sachs invited its senior analyst team to share underappreciated stocks within their coverage that still have valuation upside. VNOM, DINO, HAL and ARRY are recommended. While they have seen fairly strong returns in the E&P sector YTD, XOP plus 11%, the sector has still underperformed the XLE plus 15%, as investors' sentiment has remained mixed on the subsector relative to other groups within energy. In that environment, they still see select relative value across their coverage, particularly with VNOM with 29% upside to shares at current levels. They remain constructive on the long-term benefits stemming from the close relationship between VNOM and FANG, as well as the shareholder return profile of the pro forma pure-play Permian business in an uncertain oil environment. Across their integrated and refining coverage, they highlight HF Sinclair, DINO, buy, where they see an attractive risk-reward. While shares performed well more recently, they continue to see valuation support from current levels with about 17% total return. They highlight DINO's attractive capital returns profile, where they anticipate the company returning about $620 million, about $640 million, via buybacks and dividends in 2026-2027, implying about 6% yield each. They have seen multiple expansion across the oilfield services sector as the market looks to gain exposure to names that are levered to international activity ahead of an anticipated increase in activity at the end of 2026 into 2027. They currently see about 18% upside to current share price levels, as they apply an 8x EV over EBITDA through cycle multiple to the stock. They see continued valuation upside to HAL due to its involvement in the BTM theme, particularly internationally, where HAL and VoltaGrid see a large market opportunity. Over the past year, they have seen P over E, FY1, multiples across their utility-scale solar coverage increases by about 170% on average, but view ARRY as a stock that remains underappreciated with valuation upside. In particular, the stock's multiple expansion has lagged the broader group and currently trades at about 33% discount to its peer NXT, as opposed to being relatively in line a year ago. They see ARRY as uniquely positioned to close the gap with NXT as well as the broader coverage group, and see it as an underappreciated stock within their coverage with near-term valuation upside. However, it should be noted that the views in the research report are for investment reference only. Market conditions are complex and volatile, and investment decisions should be made in light of your own risk tolerance.